and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gives you complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and independent investment advisors Vivek Mawani and Shahina Mukaddam joining me on the show. Many thanks to both of my guests for joining me. On the show today, we discuss ICICI Securities and what's causing the rally in this counter. We also discuss Phoenix Mills and whether the rally will continue for the counter. The much talked about stock of the last few weeks has been Maruti. A big move, almost 30% from the recent lows. We ask whether the turnaround story is there for the counter or probably not. And lastly, we ask our analysts about one Nifty stock that they're recommending to their clients to buy at this point of time. But the first stock is ICICI Securities, a big rally that come in. One of the key reasons is the reports that came out indicating that from Jan, the AMFI changes in the mid cap, small cap and large cap will come in. So this will move in from a small cap to a mid cap. That is something that a couple of reports have highlighted. But what's causing the rally? Has the business fundamental changed? It's up 60% on the past 12-month basis. But remember, it's also cracked significantly from the highs that it was trading at. Vivek, anything that you spotted indicate such a rally, almost 70% in the last 9 months? What's happened there?
Okay, so three things have happened in ICICI Securities if we go a little back into recent history. Yeah, from the lows, it was at sub 200 levels, just about maybe 4-5 months ago, maybe August, September, it was at sub 200 levels. And so it has doubled from the 52-week lows recently. But even that sub 200 has to be seen in perspective that the IPO was at 500 plus. So from 500, it had fallen to 200 or less than 200, which itself was like a 60% fall post-listing. I mean, it probably had one of the most disastrous listing as well as post-listing, a controversial IPO itself, which was bailed out by Prudential ICICI Mutual Fund, and there were inquiries of conflict of interest and so on and so forth. But that's history. When we look at the what's triggered this rally, I'm tempted to draw parallel to IIFL Wealth Management, which was hived off and listed recently. It was listed only in October. And IIFL Wealth Management listed at about 1100. Even now it's trading at about those levels at a phenomenal market cap of something like 12,000 or 13,000 crore market cap. Even now IIFL Wealth Management market cap is like 13,000 crores. When IIFL Wealth got listed, ICICI Securities had a market cap, I mean, the sub 200 levels that we are talking of corresponds to market cap of less than 6,000 crores. When we look at the fundamentals or the actual financial performance, and I was like looking at the last few quarters, ICICI Securities has actually better operating matrices than IIFL Wealth. In terms of return on equity, has been upwards of 40%, 43% to be precise as of September end. IIFL Wealth is at sub 10%. Of course, IIFL Wealth has balance sheet adjustments because it was a hive off. So you have a balance sheet which is disproportionate to the P&L account. Of course, ICICI Securities doesn't have those issues. But in terms of core operating business on margins, ICICI Securities has reported 30% profit after tax margins, close to 50% EBITDA margins, 40% pre-tax margins, which are substantially higher than IIFL Wealth, which is whereabouts of 20%. I mean, they've hovered between 20-25% in the last few quarters. So margins for ICICI Securities are better, return on equity is better, and obviously the valuation was much lower than IIFL. So that is what triggered a rally post September, and the rally doesn't seem to be stopping. I mean, we just discussed this stock about 3 weeks ago as to what's really driving it. Longer term, ICICI Securities or IIFL Wealth or even JM Financial or Edelweiss or any of these financial services stocks are a very good play on the financialization of savings over the long term, as the country's savings move more from physical assets to financial assets, as well as there's deeper penetration of financial markets. However, three things also work against it, which one is really not sure as to how the earnings, margins, etc. would pan out over the medium to long term. One is very rapid technology changes, number one. Number two, regulatory clamp down on the commissions that they can earn on the distribution of financial products. Let's also recollect the likes of ICICI Securities or IIFL Wealth or Edelweiss. They are very large distribution machines with couple of million client accounts to whom they sell mutual funds, insurance, PMSs, AIFs, or basically all kinds of financial products and earn a commission on that, besides the traditional business of equity broking. So now equity broking actually for all of them is like a very small percentage, less than 25% for all of them in terms of their revenue profile. The third thing is of course competition. So there is technology aspect, regulatory aspect, and the competition aspect, where the likes of Zerodha or who probably offer zero brokerage, or number of other brokerage houses who offer a flat 10 rupees or 20 rupees brokerage on on an FNO lot size versus the traditional percentage 5 basis points, 20 or 10 or 20 basis points that brokerage has been earned. Similarly, on the mutual fund and financial distribution, stock exchanges are coming and probably ramping up in a major way. There are no commissions. There is direct distribution being done by AMCs, also doing away with the paying of commissions to an intermediary. So we really don't know in the medium to long term how the business shapes up in terms of compression of margins, lower commission rates, etc. While costs, of course, will continue to go up largely because of manpower costs and technology related costs, which require all of them to invest huge amounts of money every year. Valuations are, standalone basis at something like 26, 27 times current year earnings. They don't particularly seem cheap, but as far as the growth and ROEs is concerned, one can still justify. I'm really neutral. I'm not really a buyer even at 400 or 420. Neither was I very positive at 360 3 weeks ago when we discussed this same stock, but I'll be neutral on that.
Okay, just before I go to Shaina, you think it's fair to compare ICICI Securities to IFL Wealth? Won't a comparison to IFL Securities be a better match, because that's more into wealth management and into pure broking?
Okay, see, ICICI Securities is basically IFL Wealth plus IFL Securities put together. In case of IFL Securities is a brokerage business, IFL Wealth Management is where they do distribution of financial products and asset management. ICICI Securities actually is amalgam of both this. So which is where, I made a comparison, but actually large part, or you could say 80% of the business profile overlap in terms of revenue contribution. There is commonality with IFL Wealth. ICICI Securities is a pure brokerage business. ICICI Securities also does, besides equity broking, there is obviously investment banking, which is institutional business, and a very large quantum of revenue coming from distribution of financial products.
Okay, fair enough. That's a fair comparison. What's your sense? What do you think is causing the rally? And would you recommend this stock to any of your investors?
See, I agree with Vivek that the stock is expensive at current levels. Having said that, I think yes, for a long-term investor, I wouldn't tell him not to buy. So I would be positive on the stock. There are a couple of reasons. One is, I think in this business, technology plays a very important role, and safety of your money, right, as a client. And if you look at the clients that ICICI Securities has, they've got about active 0.9 million clients, or whatever, 9 lakh million clients, which are very active. And plus, if you look at the potential business growth, you have ICICI Bank, the parent, has about 45, I think the number is 45 million debit card holders. So if you see the potential business that can come in growth, plus the NRI business that ICICI Securities is targeting, I think all these are areas of growth for the longer term.
Okay.
And I think a seamless movement between your trading account and your bank account is a very critical it's a very critical point that a lot of smaller investors I have come across do prefer. So I see ICICI Securities capturing a large part of the business, which is moving out from the the old brokerage houses or the smaller brokers, which are facing problems currently, and with SEBI becoming more and more, I would say, with stringent laws, I think these are the ICICI Securities, HDFC Bank's trading arm. I think these will be the ones that will actually gain. So I think I would be recommending a positive, a buy. Take any dips that you get to add on.
Okay, that's the view that's coming in on the first stock. ICICI Securities is down 3.5% after a monster rally that we've seen of late. The other counter which has done extremely well is on the real estate front is Phoenix Mills. When you talk about real estate, you're already talking about the DLFs, the Godrej Properties, the Oberois, One of the stocks that's not spoken about but has moved slowly and steadily is Phoenix Mill. It's almost up 50% in the last 12 months. Do you like Phoenix Mills? Is it a stock that someone should have in their portfolio?
Yeah, I think one can have it. It is a good mid-cap stock, and I think in 2020 it should do better than what it has done in the previous year. There are a couple of reasons going behind it. They've got a well-settled business in terms of nice large malls, and I think the customer preference is towards such large malls where they can have a good. It's more like an event for it's an outing. So, and also in terms of the size of the malls, they're pretty good size, 1 million plus square feet. So I think it's a good combination of things. They've put together a decent balance sheet. So I think it will outperform some of the other peer groups in the overall segment. So I would say that it makes a good mid-cap pick for 2020.
Okay, that's the view that's coming in, positive view coming in. You think that it's a stock that you should have in your portfolio?
Well, I'm not quite sure about Phoenix Mills. Partly also, I do have a bias against real estate businesses, number one. Number two, the bias also is partly because none of the real estate companies really earn return on capital, return on equity, which is any meaningful in terms of even if I was to say double digit. Phoenix Mills, for all its strengths, earns return on equity in the vicinity of 7-8%. Even if I were to look at some of your Bloomberg estimates in terms of the research available, as I mentioned, I don't track it in detail. So I'm looking at third-party brokerage and investment banking research. Most of the estimates are still within 8-9% return on equity going forward as well. That's number one. Debt overhang continues to be there for all real estate companies, and cash flows are inadequate / strained. I mean, either it's inadequate or they are strained. From valuation point of view, at about 30 times forward earnings, I don't really find it particularly cheap either as far as the business is concerned. There are better stocks, better sectors to focus on which have much higher return on equity, much better cash flow profiles, and obviously even the valuation profile. So if you look at those multiple factors, I'm not really tempted by Phoenix Mills, notwithstanding that it has gone up 50%. So yes, I've lost an opportunity, but I'm okay with that.
Okay, that's the view that's coming in on the counter. The next stock that we want to talk about is Maruti Suzuki, and pretty much it has rallied almost 30% from the recent lows. Obviously, the monthly sales numbers will be out very, very soon, and that's something that people are watching out for. But a lot of things have changed for Maruti. What's your sense, Vivek? Is Maruti headed for a turnaround? It's not given many returns, at least in the last 12 months, but for the last 6 months, it's done well. The last 3 months, it's up 10% for a large cap stock its size. What do you think rebound is possible in Maruti Suzuki?
I think the rebound has already happened in the sense that you would recollect that on this very program, both in August and September, twice we have discussed Maruti, and even that point of time when it was at about whereabouts of 6,000 or lower, I had like stuck my neck out saying that the worst in terms of damage, in terms of collateral damage to the stock price is done with. Although there was no positive news at that point of time, positive news are still a question mark even now. But I think the sector is on the mend. I think the stocks have bottomed out, stock prices have bottomed out. Now we just need to wait for a couple of months or maybe 1 or 2 quarters for the numbers in terms of volumes to start showing a positive trend. That's number one. After the after the production cuts that Maruti and all other auto companies have taken in the last 2 or 3 quarters to adjust with the slow sales on the retail side, the trend in the last 2-3 months, especially the festive season post Navratri, so I'm talking of October, November, and hopefully even December is better. We'll know about it in the next few days. There has been significant clearing of the inventories at the dealer distributor level. That's number one. The company inventories anyway had corrected with lower production in the last few months. So if the inventories in the system inventories move to less than 1 month of sales, I think it's a time that even your production numbers and your wholesale sales will start showing an uptick. From a balance sheet strength, a very strong company, debt-free, close to 40,000 crores of cash and cash equivalents on the balance sheet itself. very high return on equity, return on capital, adjusted for the surplus cash and adjusted for the other income that they earn on the surplus on the balance sheet. Valuations at about 25 times forward, I think is not very expensive for a stock like Maruti. I would continue to be a buyer and accumulate on declines. A disclaimer, already have a holding on behalf of clients and continue to be a buyer for new inflows or new clients who come in.
Okay, that's the view that's coming in. Positive view coming in from Vivek, and he had initially also indicated that there is a turnaround that's happening in the earlier shows. What's your sense on Maruti? You think that the worst is over? You think that things will just get better for Maruti going ahead?
Yeah, I think the worst is over. As we saw in this current season of festivals, the stock has been cleared. And we've seen that the current, as Vivek mentioned, if it is less than 1 month inventory stock, it is a positive, which I think it has now. It is below one month. It is. And we've also seen the second point he raised was of production, right? And the production, they have already announced a 4% production increase. That is after, I think, about 9 to 10 months of no production increase. So I think these are positive that are there. They have also announced a price hike. So I think everything is sort of falling in place. At the same time, I don't see we're going to see a major big bounce that is going to come in, in the next 2-3 quarters in terms of profitability or revenue increase. At the same time, I think 23 to 25 times multiple, which is actually the range that I have, is pretty okay for an investment in Maruti. I think it's bottomed out. I think the bottom was 5,500. So, I think from here on, we are likely to see slight ups and downs, but I think we are moving in an uptrend. Okay, so
it's a consensus positive view that's coming in on Maruti Suzuki for a long-term hold. And the final stock is, while the markets have done well, we are asking since it's almost on the eve of 2020. For 2020, which is one Nifty stock that you've told your clients to start accumulating and which can outperform?
I like SBI because I'm positive. If you look at it both from a top-down level, I think banks will do well. PSU banks are also seeing a sentiment technical bounce. But while I'm for an investor, I still prefer the largest. So from a top-down approach, I like SBI. Also from a bottom-top approach, also I think SBI is going to do well. If you see, their provisions are almost 81% plus where we saw the last quarter. So I think it should be better this time. We are seeing a lot of resolution that is happening in the large accounts which had stressed accounts. If that comes about, it directly flows down to the bottom line. Also with yields where they are, I think M2M profits will add on, treasury profits will add on to the bottom line. Also in terms of their overall CASA, NIMs, everything seems to be on an uptrend. So I think while SBI has given you a decent performance, it was my last, I think, Diwali pick way back, last Diwali. So it has really performed from then. But if I look at it going forward, even from today, I think there is an upside because there are very few opportunities in terms of sector plus stock which have positives going ahead for the next year. So in these difficult times, I think stock like SBI should do well. One more thing, in terms of the main problem with PSU banks is the way they are able to fund growth. Credit growth is low as of now. So how are they going to fund growth? And I think SBI is doing a pretty good job of it in terms of they have got a lot of these subsidiaries and they are sort of monetizing these subsidiaries and they will continue to do that. So I think in terms of fundraising also they are very well positioned compared to most of the other banks, you name it, private or public sector banks. So I would stick to a safe bet. SBI.
You think SBI probably will outperform even some of the private sector banks, even the large quality names like a Kotak or a HDFC Bank? You think that if someone has to take a bet, they should rather stick with SBI than go in for a private sector bank?
As of today, yes, because if you see the price to book, it is just about 1.2. Even after this price increase, it's not above 1.3 on a console basis.
So valuation-wise, it's attractive.
Valuation-wise, it's attractive. So while I continue, if you're holding private sector banks, nobody's selling. But at the same time, if you're adding, why not SBI?
Okay, that's the view. So SBI, and Vivek, I believe yours is also SBI, right?
Yeah, mine is also SBI. So say that probably there seems to have been telepathy between me and Shaheen, or I didn't know meeting of minds to this extent. So the only thing that I could add is, of course, in terms of resolutions, SR Steel, the largest of the NPAs. I mean, the resolution happened in resolution and the recovery. Almost 40,000 crores flowing, not entirely coming to SBI, but almost 30,000 crores coming to SBI in December. number one. Going forward also, as the chairman and MD has indicated in the previous quarterly guidances, that something like 15,000 crores of I would say resolution / recoveries is something that they were expecting in the current year. Not all of it will come in the fourth quarter, but probably in the Q1 and Q2 of next year it may come. So what we are seeing is in the next 6 to 9 months, substantial amount of inflows coming in. Most of it has been fully provided, so all of those recoveries is actually incremental profit. Valuations at one time price to book on a consolidated basis, 1.2 on a standalone basis. So if you were to take the subsidiary valuations, probably it's about 120, 125 rupees per share at this point of time. Of course, the largest of those subsidiary value unlocking is going to be SBI Cards, which is expected in the next 1 or 2 months, which itself will give it another couple of thousand crores, because SBI Cards IPO, by the way, is an OFS where SBI and there's a private equity investor, I forget the name, who are actually offloading their holdings and encashing that. So obviously all of the IPO, much of the IPO money will flow to SBI in terms of value unlocking / capital being available for next year to fund growth. Just last point, in terms of return on equity going forward, I mean, the management has indicated about 12% for March 20, but I think in the next 2 years they should be hitting 15% return on equity if all things were to continue. Most important, of course, the credit and the credit cycle and investment cycle on the corporate side. If that were to pick up, we'll probably start having even double-digit credit growth. So all of the positives seem to fall in place in SBI for 2020. Valuations are compelling, and one is at a pain constrained to see what is negative at this point of time at a price of 330 in SBI.
Okay, that's the view that's coming in. I think consensus view on the Nifty stock that should be accumulated, and that is SBI. But with that, it's a wrap on today's edition of Hot Money. Let me thank both of my guests who come today, Shaina as well as Vivek. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg.